The material we have today is this really high-energy, data-packed look at SoFi's pivot to becoming a profitable bank and, how Wall Street is finally catching on.
Yeah, it's a very strong piece, and timely too, with that theme of, analyst upgrades are in. The data foundation is solid. Our focus here will be on sharpening that analytical edge to really maximize the impact.
Okay, so let's dive right in. Our first opportunity is about connecting the dots, really bridging the gap between the raw financial numbers and the actual reasoning behind these huge analyst price targets.
Right. The piece does a great job presenting all these powerful individual data points about SoFi's performance, but the overall narrative could be a lot stronger if it explicitly integrated the why, the performance metrics, with the who, meaning the specific analyst theses.
Exactly. From the notes, you can see it effectively lays out the drivers. You've got the raised guidance for 2025, something like $3.5 billion in revenue.
And over $1 billion in EBITDA. And crucially, that massive jump in tangible book value, the TBV, forecast to hit $2.5 billion.
Yeah, and then right after that, we get the analyst spotlight, Citigroup's unique winner thesis, Needham's super app idea, both with these huge $36, $37 price targets.
That's all clearly laid out, but, the connection feels a bit disconnected, We go from these incredible numbers to the analysts' conclusions almost too quickly.
The analytical bridge is sort of implied, but not really built. Is that connection between that stunning $2.5 billion TBV forecast and those specific price targets really established, or is that somewhere we could bolster things?
I think that's a necessary refinement, yeah. For a sophisticated reader, just listing the numbers and then the targets, it feels more like a news summary. To make it real analysis, you have to show how the analysts got that conviction from these specific metrics.
So the suggestion here is pretty straightforward. The analysis should integrate the performance metrics directly into the analyst commentary. You need to show the analytical link that drove their conviction.
Let's talk concrete examples. We have to show how to weave that in so it feels seamless, so the metrics become the evidence.
For instance, when you cite Needham's super app thesis, the one about the compounding effect, you need to explicitly link it back to that data point showing fee-based revenues surged 50%.
Right, because that surge isn't just a number, it's proof. It shows that the ecosystem stickiness they're talking about is translating directly into less risky, high-margin revenue.
It's the quantifiable evidence that the super app strategy is actually working financially, not just a buzzword.
And it speaks to the compounding part directly. Lending profits are linear, but this fee-based revenue, that can compound profitability because it's leveraging tech and users with minimal balance sheet risk. You're showing the reader the how.
Okay, and then similarly for Citigroup's unique winner positioning.
You use that massive TBV jump as the main evidence. Argue that for a regulated bank, accelerating TBV means it's building real, hard asset value, not just chasing risky loan growth.
So that structural strength is what justifies calling it a unique winner and slapping that high price target on it?
Exactly. You're using the metrics as the foundation for the commentary. It just maximizes the rigor of the whole piece.
That gives the structure some serious support. Okay, let's move on our second big opportunity, and this one's about handling the skepticism.
This is vital. A strong bull thesis has to proactively, deal with the main counterargument. If you don't, the reader will just fill that gap with their own doubts.
So to maximize the material's impact, the necessary inclusion of the counterpoint about high valuation should be more deeply analyzed, rather than just being dismissed with that growth-focused PEG ratio argument.
Yeah, the piece correctly identifies the main pushback. Critics, like KBW, are worried the stock is expensive, like 50 times PE, and they raise the risk of rising loan defaults.
An immediate rebuttal is just that the company will grow into the valuation because of its 50% plus earnings growth.
I get why you'd go to the PEG ratio. It's a standard defense for a growth stock. But just focusing on that, it kind of overlooks the specific risk the critics cited, which is loan defaults. A smart reader will see that as a deflection.
So there's a risk that focusing only on the growth multiple overlooks the operational steps SoFi is already taking to mitigate that core lending risk, which is the real defense.
That's the exact tension. The PE versus PEG argument is fine, but it misses a chance to redefine the company's entire risk profile using information that's already in the material.
The argument needs to shift from, is the price high, to something more like, is the business model fundamentally less risky than critics believe?
Yes, and that's why the suggestion is to strengthen the material By actively connecting the risk mitigation strategy to the valuation rebuttal, you shift the whole debate.
You neutralize the risk before you even talk about the reward.
Exactly. So bolster the rebuttal by referencing that revenue quality shift section. You have to highlight the fact that the loan platform business, where they originate loans for others, nearly quadrupled in volume.
Which shows they're becoming more of a tech provider. They facilitate lending without holding all that risk on their own balance sheet.
So instead of just arguing, we're growing fast, pay up, you're saying we are fundamentally shifting our revenue away from the risky part you're worried about. It's a much more powerful and, frankly, more defensible position.
Right. By demonstrating that an accelerating portion of their loan activity is fee-based, with less balance sheet exposure, you're directly addressing that loan default risk concern head-on.
It makes the valuation argument much more robust. You're not just arguing about multiples anymore, you're arguing about the improving quality of the underlying business. It elevates the whole discussion.
That is an incredibly actionable way to make the argument pretty much bulletproof against that main skeptic concern.
Okay, so let's move to the third critique. This one focuses on that fascinating data point about institutional flows. This is where the story about Wall Street finally loves SoFi gets really interesting.
Yeah, the smart money is moving. And when you see moves this big, there's always a deeper story than just, investment interest.
The piece has this highly compelling fact about JP Morgan Chase adding over 42 million shares, like an 880% increase. But the analysis of the strategic implication of this could be elevated way beyond mere validation.
I do like this data point, though. The fact that the biggest bank in the U.S. is accumulating shares. That strongly validates the whole thesis for a retail investor audience. It signals confidence.
It is a powerful validation point, but we have to ask, what's the subtext here? Just saying Wall Street loves SoFi is good, but why is JP Morgan, a direct and powerful competitor, loading up on shares?
Is it just a passive investment? Or a signal of some kind of strategic interest? Maybe a hedge against a rising competitor?
Or validation of a specific technological advantage, like their tech stack. That's the crucial distinction. We need to move the analysis from they bought it because they like it to they bought it because it implies X about the future.
That's the analytical leap the audience is looking for. If you're writing for a sophisticated crowd, this is where you earn your stripes, interpreting those institutional chess moves.
So the suggestion is to frame this institutional accumulation not just as a proof point, but as a strategic development that demands a deeper analytical inquiry into the competitive landscape.
Okay, so how do we translate that into some concrete, thought-provoking examples for the material?
Well, you could introduce a brief exploratory section that just asks the questions. Like, what does this imply for the future of fintech, given SoFi is now GAAP profitable with over $26 billion in deposits? Does JP Morgan's buying spree imply a growing belief in the value of SoFi's tech stack, like Galileo or Technisys?
They're essentially buying into a tech provider they might otherwise have to compete with, or even license from.
That's one strong line of inquiry. Or you could frame it as a stability or M&A metric.
Right. Does having a major player like JP Morgan on this shareholder list make SoFi a more attractive or stable target for future strategic action, like a partnership or even M&A?
Exactly. The presence of a major competitor on the shareholder register, that's extremely relevant for retail investors thinking about their long-term strategy. This kind of informed speculation turns the article's impact way up.
It turns it from just a good analysis of recent news into more of a foresight piece. It leaves the reader with deeper questions about the strategic future, which is much more valuable.
It ensures the material speaks to the significance of the data, not just reporting the numbers.
Okay, so that concludes our primary analysis today. We've really covered three main opportunities for strengthening this excellent report.
First, tying that precise financial data, like the $2.5 billion TVV forecast and the surge in fee revenue, directly to the specific analyst theses.
Make that analytical bridge explicit so the reader can see how they got there.
Second, deepening that rebuttal to the valuation concerns. Use the risk mitigation evidence you already have to counter the specific loan default fears.
Yeah, fundamentally change how the reader sees the risk profile of the company.
And finally, analyzing the strategic implications of that institutional buying, moving beyond just using JP Morgan's move as validation, and instead framing it as a strategic signal about the future of fintech.
These suggestions are all aimed at maximizing that analytical depth and making sure the material appeals to both the bull and the skeptic.
Your foundation of data is highly impressive. The shift to profitable growth, that fee-based revenue surge, it's all there.
We invite you to make these revisions and submit your work back in for another round of critique. We look forward to seeing the results of these strategic refinements.
Absolutely. Until next time.